TV18.
The Nifty is up about 30 odd points. As far as the Nifty is concerned, we are sitting with cuts of 44 points. It has recovered a tad bit from the lows. Right now, Nifty is down 50 points.
The Indian markets, as we speak, are just down close to about 0.1%. There has been a bit of a rebound.
It was a decent day of trade. Buy on dips did play out yet again. Metals was the stock in focus. The Nifty ended more or less flattish. The metal index was up close to around 3%.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Sonal Bhutra and here are the headlines for the day. Markets recover from early weakness to end flat after a fairly choppy session. Mid-cap index hits 52-week high while IT stocks drag. SBI, Hindalco and HDFC Bank all bat for the bulls. Metal stocks shine as metal prices rise following further ease of restrictions in China and a weaker dollar. The index gains 2% while Hindalco and Tata Steel close with gains of over 4%. Oil prices rise as G7 nations agree to cap Russian oil at $60 a barrel. Russia says it will not abide by the measure even if it has to cut production. Several mid-cap financials scale to 52-week highs after drop in NPA stress for Mahindra Finance and a positive commentary on growth from ICICI Bank boosts sentiment. LTI Mindtree clocks cuts of 2% after listing on the exchanges today. Angel One loses 3% after client additions and market share falls in November. And here's the lineup of what we have in store for you. It's a packed show today. In Market Opinion, we have Edward Morse of Citi and Gautam Trivedi of Nepean Capital. And in Corporate Voices, we have Rajesh Jujurikar, Executive Director, Auto and Farm Sectors at M&M on the tractor business and its growth. And it's a choppy session of trade today. It saw the Nifty and the Sensex ending the day flat. The broader markets outperformed the benchmark indices. IT stocks were a major drag on the Nifty, while metals did well. Nigel D'Souza is here with a wrap of all the day's trading action. Nigel.
Well, it was a good day of trade actually. You'll say the Nifty ended more or less flattish, but the broader market participation is something that the street will like. The buy on dips on the Nifty worked yet again. Intraday, we went down to around 18,600. But if you bought those dips, you got 30, 40 point dips intraday, well, you'll be happy because we did see quite a bit of bounce. And the broader market participation, that's encouraging because that's been lagging. Now, on the Nifty itself, Reliance Industries was down 1.5%, but the banks and the financial names more than made up for what Reliance Industries didn't perform today. Now, in terms of the reopening trade, the China reopening trade, it had a rub-off effect on metal stocks. So both ferrous and non-ferrous names, they went running away in trade. But just one word of caution out there. If metal prices are going to move up, it won't be very, very good news because input costs start spiking up and that in turn will hurt earnings. For the time being, we're treating this at a bit of a bounce. The reopened trade has helped stocks like Tata Steel, Hindalco, as well as JSW Steel. But there was another pocket that did well. The NBFCs, Mahindra and Mahindra Financial Services, they came out with their monthly update, and the street liked that. Piramal Enterprises has seen a sharp downtick, but that bounced back in trade as well. Remember, in the last few weeks, well, it's been under some pressure, but today it did bounce up. And even Manappuram Finance, well, that stock did see a bit of a relief rally. And some of those outperformers like TVS Motors and BHAL, they came in for some mild profit taking. What's the outlook for the markets from here on? Well, the Nifty is likely to be in that band of around 18,550 to around 18,850. That's the high we hit, by the way, in the past week itself. The RBI commentary, that's going to be very, very crucial in the next couple of days, and that's what will give further direction, both to the Nifty as well as the Nifty Bank. But the heartening aspect is that we are seeing broader market performance, and now you're feeling that, yes, we are at all-time highs. Otherwise, portfolios were hurt, but for the last few sessions, well, that's turned around a little bit. Continuation of this mid-cap, small-cap outperformance is something that the bulls will like.
Okay, Nigel, thank you so much for joining us with that market wrap. Let's move on to the market opinion now. Indian equity markets have seen net flows of around $22 billion. That's the word from Gautam Trivedi of Nepean Capital. In a chat with CNBC-TV18, he added that India needs another $5 billion to witness a significant impact. Listen in.
If I look at the absolute amount year-to-date invested in the Indian market, so FIs are a negative $17 billion. Domestic mutual funds are a positive $33 billion. And if I look at the NSE data that comes out on retail participation in the market, we're roughly about 8 or 8.5 billion of retail year-to-date net. These are all net numbers. So if you add that up, you get about $22 billion of net flows into the Indian equity markets, counting everybody who's participating in it. If another $5 billion inflows or outflows were to come into this market, again, keeping in mind that our total market cap is as big as 3.3 trillion, fourth largest in the world, another $5 billion inflows or outflows could have a significant market impact. I still stand by the fact that we are in the middle of a bear market rally. We're not out of the woods. The other thing, of course, is if you look at the Bloomberg consensus for world GDP growth, it's down from, as in this year, estimates are 2.9%, and next year, 2023 calendar, are anywhere from 1.8 to 2%. So clearly a slowdown. The question really is, how deep does the recession in the US and Europe get to? And nobody has an answer to that. Now, if you look at the MSCI All Country World Index, the United States accounts for 61% in terms of weightage. So that will drag down the rest of the world if a recession were to get deep.
Okay, all right. That is some market opinion coming in. To the second headline now. Metal stocks, they saw good gains in trade today as metal prices rose. This on the back of positive sentiment following further ease of restrictions in China and a weaker dollar. The index gained 2%, while Hindalco and Tata Steel closed with gains of over 3%. Manisha Gupta is here with a wrap on the sector and what's moving along here. Manisha.
Further gains in metal prices is how we have started this week as well. A very strong last week and a very strong month of November, where we saw most metal prices gain up anywhere between 8 to 28% on the higher side. December has begun on a positive note there. So much so that you have copper prices trading at a 4-month highs and the other metals also trading at multi-month highs. If you look at the last 1 week itself, we have copper prices gained up by 7%, aluminum up by nearly 8%, zinc gained up by 5% as well. The decline in US dollar index at a 4-month lows has been supportive. China also rolling back many of its COVID restrictions, and bigger cities like Shanghai opening up yet again has been positive. And then China has done a lot in way of liquidity injection, more stimuluses for the real estate sector. Also cutting the reserve ratio by 25 basis points has been supportive for metal prices, which anyway have had strong fundamentals, as we have seen production in Europe continue to decline. The LME inventories are at multi-year lows as well. So metals were strong fundamentally, but with the macro as well changing, there is a lot of support coming in for this space.
All right, Manisha, thank you so much for joining us with all those details. To the third headline today, the G7 nations have agreed to cap the price of Russian oil at $60 a barrel. This is aimed at limiting Russia's ability to finance its war in Ukraine. In response, Russia said it will not abide by the measure even if it has to cut production. Separately, the OPEC Plus has agreed to stick to their October plan to cut output by 2 million barrels per day starting November 2023. Manisha is back with us once again with a wrap on all the action from the energy space. Manisha, a lot happening here.
Well, yes, after 6% gains in the previous week, the crude prices have started this week on a positive note as well. Well, the US dollar index continues to slide down, now at 104, a 4-month lows, and that has been supportive for mostly dollar-denominated commodities. For the crude oil prices, the major push also comes in as China, one of the major importers and consumers of crude, is now dialing back on various stringent COVID restrictions. That means that the demand could be coming back soon and is supportive. Weekend was busy. You had the OPEC and allies meeting on Sunday, where they have decided to stay pat on the output that they are producing, as in the case of November, until 2023. And that led to some confidence too. And then you have the European Union, which is set to ban most seaborne Russian crude oil coming into the country. There also is a price cap now in process from the European Union. They have agreed to impose a price cap of $60 per barrel. So the markets are looking at all of its impact on ground reality, also whether or not Russia in some way will retaliate with the stopping crude production or exports to many of these countries, or would that come in sense of metal exports to many of these countries, is something that the street is waiting for. Also, you have a strong winter demand standing in front of you, so whether it's crude prices, natural gas, all of that is trading in the positive.
Okay, Manisha, thank you so much for joining us with all those updates. Meanwhile, Edward Morse of Citi says oil price cap is well below the European prices. He adds that the market is moving due to China opening and weakening dollar. He says more volatility expected in coming times as well. Listen in.
The oil cap is well below where the European price is. It's above where Asian prices are, but they don't matter much in terms of the oil caps. So for all practical purposes, the oil cap is irrelevant by a good $8 to $10 a barrel. We have a cap at 60, and most seaborne crude, which is what this is all about, going into the west from Russia is in the $50 range. So there won't be any impact unless Moscow goes ahead with its threat and says, we're not going to export X amount for whatever reason. But so far, we don't think that's going to happen. And the market has not moved a lot. The market has been moving for reasons other than what's happened over the weekend. The market's been moving because of optimism about China opening and concerns about the US dollar because the Fed might be reducing the pace at which it's raising rates. Both of those may be iffy, by the way. So I think we're going to have the same kind of volatility in the market that we've had, through the fourth quarter. We'll find out that China is not going to be rebounding in terms of demand until sometime after the first quarter is over. And we'll find out probably that given the other thing that the Fed reads, namely the pace of growth in the US economy, that they're going to not relent on raising rates. So we'll see what happens. But I think volatility is what we should expect rather than a continuing rise in prices. Well, I look at supply and demand, and I don't know what Saudi Arabia and the UAE are going to do. I know they have a difference of view. I know they have to monetize their reserves and do that for a while. But when we look at supply and demand balances, we're looking, as we did this year, at a surplus and lower prices. We happen to have prices at the end of the year that were equal to those at the beginning of the year. They're not higher. When we think about next year, we're looking in our numbers at about 1,300,000 barrels a day of demand and 2.5 million barrels a day of incremental supply. That means that OPEC has to make a decision, the OPEC plus countries, as to what they're going to do. Now, there's plenty of margin of error because there are so many unknowns. Is Russian production going to go down? We don't think so. We think that there are going to be enough buyers found in the world, in the markets as they exist, that Russian production is going to stay more or less where it is. If it's going to be down, it won't be down by 1 million barrels a day. It may be down by 200,000 or 300,000 barrels a day. But as between the Western Hemisphere's growth, which is in itself close to 2 million barrels a day, and the unknowns associated with Libya, Nigeria, Iran, Iraq, Venezuela, we could have disruption to supply by 2 million barrels a day, or we could have an addition of 1 million. So, the geopolitics of this based on what's happening in domestic economies is extremely hard to read.
Okay, that is some expert opinion coming in on the crude markets, but let's move on and connect it with automobiles because M&M reported very strong sales for November in the auto and tractor segments. Rajesh Jajurikar, Executive Director of Auto and Farm Sectors at Mahindra and Mahindra, says the tractor industry expects 5% growth. Listen in to what he had to say.
We have said a little over 5% and we'll stay with that. So November was better than what we had expected, and let's wait and watch how that goes. We actually had a very robust November sales in tractors, growing our domestic volumes by 11%. We gained 2% market share, and hence cumulative on the tractor side, we are actually a 0.9% market share gain, which on our level of volume is a very substantial gain. So we continue to do well with the very strong product offering on the Mahindra tractors and the Swaraj tractors both. The Yuvo Tech, which we had launched a few months back, is doing very well and helping us gain market share. We have seen a significant improvement in our margin over the last 3-4 quarters on the auto side. It was in the region of 3.6% towards Q3 of the last year, and it's moved up to over 6% right now. This has happened through operating leverage, cost reductions, some of the products which were launched earlier, getting out of the the initial booking price which we had held on to. So we have seen a significant improvement in our margin, and there is a lot of focus on driving costs down as we go forward.
All right, that's the word coming in from M&M. It's time for a break now, but stay tuned. We'll be back in a jiffy with the other headlines. Welcome back. You're still tuned into Markets Today on CNBC-TV18. Let's track the rest of the headlines that we are going to be bringing for you. To the fourth headline today, several mid-cap financials scaled to 52-week highs after positive commentary and a strong business update for the sector's major players improved sentiment. In stock-specific news, M&M Financial gained 5% after its business update for November that shows that NPA stress is reducing. Abhishek Kothari is here with more.
Well, to begin with, the November business update of Emami Finance did mention that they had a monthly disbursements of 4,500 crore, which is a decline of more than 14% on a month-on-month basis. So in last 7 quarters, this is the highest rate of decline that you are seeing. But on the positive side, the collection efficiency was robust, coming in at 96% when compared to 91% in the previous month. The gross NPA ratio has remained stable at around 7% level for November when compared to 7% in October, and this compares to about 6.7% for the month of September. In that, the stage 2 or the loans due between 60 days to 90 days has actually seen an improvement on month-on-month basis. So analysts remain bullish on the stock. CLSA has written a note on Emami Finance. They have a buy recommendation and a target price of 260 per share. They say that the disbursal tractions remain healthy and collections were strong. The stage 2 has improved with stage 3 loans remaining stable. So management expects both to improve in the month of December or by Q3 FY23 due to seasonality. The only negative surprise which CLSA mentioned could be on the net interest margin or on the operating expenses side. Morgan Stanley has also written a note on Emami Finance with an overweight rating and a target price of 275 per share. They say that disbursements and collections have remained strong in November, aided by the fact that there were macro tailwinds which the management has highlighted. So collection efficiency in the month of November rose both month on month and year on year, and with asset quality remaining stable, they remain positive on the stock. Back to you.
Okay, Abhishek, but stay with us. Gold finance companies also were in focus today. This is on the back of a positive brokerage commentary. Give us more details.
So for Manappuram, they have an overweight rating with a target price of 150 per share, which is an increase of about 25.6% compared to Friday's closing price. And they have initiated on Muthoot Finance with an equal weight rating, a target price of 1,150, which is an upside of 1.25% compared to Friday's closing price. They say that gold lending business has been very good with a super normal ROE but low growth, given the fact that there is competition from the banks. So diversification is the way out. Manappuram looks better positioned than Muthoot Finance due to cyclicality and structurally. They believe that valuation multiples are also attractive for Manappuram. Back to you.
All right, that's all the update from the financial space, but let's move on to the fifth headline. LTI Mindtree shares listed on exchanges today and are now available for trading. The stock closed lower in trade. Reema Tendulkar is here with more details. Reema.
Thanks so much for that. So LTI will now be called LTI Mindtree, and the ticker, instead of being LTI, will be LTIM. Now, what has changed? Everything about the merger was known. But if you remember, the swap ratio told you if you have 100 shares of Mindtree, you will get 73 shares of LTI. So now those extra shares of LTI Mindtree will now be available for trading. So if I had Mindtree shares, I will now in my account have those LTI shares post the swap ratio. So this share base has gotten expanded. So that's the only change which has happened. There was not expected to be any big stock price impact because all of it was priced in. What's the merged entity looking like? It's the 6th largest Indian IT company by way of revenues. The annualized revenue run rate, if you annualize the Q2 revenues, should be in excess of $4 billion. It emerges as the 5th largest IT company by market capitalization, with a market cap which is closer to 1.5 lakh crores. It overtakes Tech Mahindra as well. The portfolios of the two companies are seen fairly complementary. The company, in an interview to us just last month, said that the two companies together would have more than 700 clients, but only 10 to 12 of them are overlapping. What's the risk per se? One is expensive valuations, especially compared to the other large cap peers as well as the mid cap peers. It trades at close to 30 times forward multiple, and some shareholders will be holding LTI as well as Mindtree. Now you're going to be getting a lot more shares of only one entity. So suppose you don't want it, there is always that risk of that excess supply getting sold into the market. Back to you.
Reema, thank you so much for all those details. One more stock in focus, Angel One, lost close to 5% after client additions and market share fell in November. Surbhi Sadaria is here to give us a sense of what's going on. Over to you, Surbhi.
Angel One has released their November business update and it's a weak set of numbers. Their gross client acquisition was down in third consecutive month. It was down 6% on a month-on-month basis. Their number of orders were marginally up, but this is mainly because there were higher number of trading days this month compared to the previous. They have seen a significant drop in the client funding book as well. The client funding book was down 18% on a month-on-month basis at 1292 crores versus 1575 crores in the previous month. It has lost market shares across all segments, F&O, equity, cash and commodity. First time in 7 months, it has lost market share in the commodity segment. It is down 210 basis points at 51.3% versus 53.4% in the previous month.
Okay, thank you, Surbhi, for that. Moving on, the Shriram Group has formally announced the structure of the merged entity. Remember, promoter company Shriram Capital and SME lender Shriram City Union were merged into the group's flagship Shriram Transport effective April. Lata Venkatesh is here with the key announcements today and some leads about the story henceforth.
Well, the listing of the new share, that is Shriram Transport, which is now being called Shriram Finance, will happen to reflect the merger in 2 weeks. That's the key that we got, and the major appointments. All the appointments also are on expected lines, or as pre-announced lines. Vice Chairman will be Mr. Umesh Revankar, who was formerly heading Shriram Transport, and Mr. Y.S. Chakravarti, who was heading Shriram City Union, will be the Managing Director and CEO of the new company. He gets a 3-year term. Those are the formal announcements come today. But effectively, what this means is that the second largest NBFC is born. You know, their total AUM, if you put Shriram City Union and Transport together, it's about 1.7 lakh crore. And Bajaj Finance, if you only take their retail book, will be about 1.8 lakh crore. So a fairly important giant has emerged. Now, what do the company sources say about the merger? They spoke to us after the press conference, and they say that the merger cost in terms of duties was about 200 crore and another 500 crore in terms of other expenses. But the gain will be that now the merged entity will get Shriram Transport's rating, which is AA+. Shriram City Union did not have that rating. So overall, the cost of funds will be an advantage. They don't see any impact of the rise in rates in the market on them in terms of their margins, indicating they probably can pass it on. They see a lot of synergy, of course, in terms of people in Shriram City Union being able to sell transport loans, or both entities being able to sell more kinds of loans to the same clientele. That's where they see synergies coming. And, the product question to them is whether now that you don't have, any large one single conglomerate holding you, will there be any talks of being a bank? These sources brushed aside the question, saying that discussions are always there in the board about many things, but they intend to operate as an NBFC because they are better able to serve peripheral areas. The other big question, of course, is that Piramal Enterprises, which is now a big NBFC in its own right, has publicly stated that it wants to exit Shriram Group. So the management sources that spoke to us said that they are talking to a lot of people, to funds, and they see a lot of interest, so they don't see it as a major overhang.
Lata, thank you so much for joining us and explaining to us what the new merged entity would look like. It's time to put spotlight on the stocks that remain in headlines today. Hudson Agro and Exchange Dilip Bilkon. Vaishta is here to give us the latest.
Well, thanks for that. Hudson Agro Products is the first stock that I'm going to be talking about, which is in news today and has raised 302 crores via the rights issue, where the issue price is fixed at 419 rupees per share, and the record date is 8th of December. The rights entitlement ratio is fixed at 1 rights equity share for every 30 shares which are held by the shareholders. Moving on to Ion Exchange, wherein the company has been awarded a contract by the Indian Oil Corporation, and this is for designing, engineering, manufacturing, supply, commissioning and operation and maintenance. This is for a period of 5 years of zero liquid discharge plant at their Panipat refinery. The contract value is fixed at approximately 350 crores and the project is to be commissioned within a span of 16 months. The next stock is Dilip Bilkon, which has executed a contract agreement with the Gujarat Metro Rail Corporation. This is for the construction of the Corridor 2 of the phase 1 of the Surat Metro Rail project, wherein the project cost is 700 crores. Back to you.
Thank you, Vaishta, for joining us and telling us what happened in these broader market stocks today. And with that, it's a wrap on this edition of Markets Today. Thank you for watching.